let me guess. You are busy. Your life feels full. And you feel often, dare I say, rushed off your feet. Like there just is not enough time in the days to do all the things. Because you, my friend, are working to, cover the cost that seems to continually increase at a very rapid pace to survive life, be it your rent, your mortgage, you might have school fees, putting food on the table, the pet that has astronomical costs, or is that just me? But what happens if one day something changes? You get sick or, God forbid, injured. You're still going to need to pay your rent, right? Or that mortgage. You're still going to need to put food on the table. That pet probably still has ongoing costs. So whilst you may have covered all of the things around you, what is covering your income? Welcome to episode 2 of my, accidental mini-series on insurance, inspired by my own medical events of recent years, but also my family's medical events. If you missed the last episode, welcome. You've landed in an insurance mini-series, and you are so welcome. But you might want to go back and listen to the quite long ramble that I did in the episode before this, because I talked about different types of insurances held within super and outside of super, and I went through life insurance. Today, I want to talk about income protection, because we are the geese, if you will, that lay golden eggs. I know it's a very strange analogy, but it is true. And whilst we are busy being busy, we often don't have the time or inclination to really think about what would actually happen if my income stopped. And we can easily resolve that in our brain sometimes to be like, oh, I've got emergency savings, or I've got annual leave, or I've got long service leave. But that only goes so far. So today I want to talk about income protection and get real and honest about why having a buffer of emergency savings is good but not enough. And frankly, that income protection for a lot of people should be considered an essential, not an optional in their budget. So strap yourself in. If you're of working age, which means you go to work for an income and you need that income to survive, then I definitely want you to listen to today's episode. This is a podcast for everyone that wants to learn how to make fierce and bold choices with their money. We'll talk about how to shape your money mindset, investing for your future, your spending habits, the good and the bad, plus how to achieve your financial goals, and most of all, how to be financially fierce. I am a financial educator, and I want to empower you to be more in control of your money and build the financial future that you want. I run the Greenhouse Money Growing Program, and you can find details of that in the podcast show notes. My name is Jessica Brady. It's time to get financially fierce. So let's just do some language things here, because I was going to say we, but I'm no longer inside an insurance company. So the finance peeps have a habit of making several terms or giving several terms for the same thing. The classic example is shares, stocks, equities. They're all the same thing. Why we use several different words to say the same thing? I don't know. Perhaps we're just trying to confuse you. Same with insurances. We talked in the last episode about life insurance, which is actually just death insurance. Income protection is often also called salary continuance, especially so if you have it through superannuation. But income protection effectively covers you and your income. But it is not as simple as it sounds, because, is anything. And also, we're dealing with insurance. So it gets complex fast. So today I'm going to go through what it is, who needs it, what you need to consider, the detail in the detail, not all of it, because I'm not here to read you the Riot Act or an insurance product disclosure statement, as it were. But I want to go through the top things, considerations at claim stage, and just all the things that many people have told me that they wish they knew earlier, so that they could have done something differently in case you are at that earlier stage, so that you could potentially go and do something differently. Firstly, what I want to say is you can hold income protection inside superannuation. You might already even have it, but if you listen to the last episode, you will note that I said that I find it really annoying and weird that often I called it gift with purchase insurance that sometimes comes with your super, which is you didn't apply for it, you just kind of got given it when you became a member, is often inappropriate for your life. And I find it really odd that in lots of circumstances that I saw giving advice, they gave young people a lot of life insurance, but not income protection. Whereas I looked at them and thought, yeah, your biggest risk, financially speaking right now, is if you were never able to work again. Not necessarily death, which would be tragic and awful, but actually you don't have a lot of financial repercussions if that was to happen. But if you couldn't work again, holy dooly, you have a lot of life ahead of you and thus a lot of bills ahead of you. That is a huge risk. And I don't understand why it is that income protection is not the one that's gifted with purchase, if you will, upfront inside superannuation. Some do, but not many. But that is the weird conundrum of the beast that is superannuation. And I don't have all the answers. Just here to poke at the problem. So if you are someone who works and you know that based on your current age and your current financial position, you would be kind of a little bit, maybe a lot bit screwed if you were never able to work again before you could access retirement savings, being it your super, then you probs need to listen very carefully to today's episode. Now, the never work again piece is extreme because you might be like, I'm 30. I can't access my superannuation until I'm 67. Do you really think I'm not going to be able to work for nearly 40 years? That feels like a lot to me. Obviously, that is the most extreme, worst case scenario. And I hope that never happens to you. But even if you were off for 12 months, 2 years, 5 years, for most people, they could handle a couple of months. It would probably still give them some stress, but if they had emergency savings, it could probably work. But as soon as you go further afield for a longer protracted period of time, it is very likely that you are going to run out of cash, that you are going to need to make some difficult decisions. Maybe you're going to need to move. Remember, we're talking about a time where you're not well. So having to think about all of that, or the idea of moving home when you might not want to, feels average. You might have to sell your home, sell your assets. You might need to apply for financial hardship to get money out of your super, which normally is a limited amount of money and is going to reduce your retirement savings. None of these are great options. And look, being sick at all is not a great option, which I recognize. But why we take out life insurance is to make sure that if we got sick or injured, we would have a monthly amount paid to us in arrears so that we could keep the lights on. This is not having extra money to go and do fancy things necessarily. It's very rare that happens, and I'll explain why in a moment. But we want you to not be plunged into financial ruin or desperate situations if you couldn't work for longer than your emergency savings. As you get older, as you get to the end of your working career, or as your assets build and you're starting to get a larger amount of passive income, you might look at it and go, actually, I don't really need this income protection thing anymore because I got enough assets I can self-insure, which means I can cover my own ass. I've got enough income coming in through my assets that I could cover my costs. This is no longer a priority for me. Now, that is but a small portion of the Australian population, but it is a portion, and it's kind of aspirational, right? You're yeah, I want to build enough assets to be able to get to that point. Well, annoyingly, you're going to have to take a chunk out of your budget to protect those assets simultaneously. It feels counterintuitive, but you kind of need to, right? Otherwise, those assets are the things that you're going to have to live off and erode down over time if you don't have an income for a prolonged period. People often say to me, what about Centrelink? What about NDIS? What about private health cover? Let's just pause and do some myth busting there. As far as I'm aware, Centrelink payments are not linked at all to your income. They provide minimum wage at best, and there's quite a lot of hoops you got to go through. If you earn over whatever that minimum wage is, you have to recognize that if you are relying on that, if you're even eligible, you are probably going to have a big shortfall or gap to fill. And I'm pretty certain that you trying to live on that would have you plunged into poverty. It's like modern day poverty. If you've ever seen the age pension, it's actually horrific. NDIS is normally not really about covering your costs. It's about getting support services in. Again, it can take a really long time for you to be assessed for that. And normally it's paid to providers if they're giving you services and support. So it's not going to necessarily pay your bills. as far as I'm aware. And if you've ever had any interaction with your private health company, you will know that they do not cover all of the things. Normally, there's quite a considerable gap if you've got a medical situation unfolding that you get private care for. And most people do, because public systems can have quite long waits. And that is not going to pay your bills. So when we talk about income protection, we are talking about paying a percentage of your income if you are no longer able to work due to illness or injury, so you can keep paying your bills. Let's dive a little bit deeper into that. How can you own this policy? You can own it yourself, which seems obvious. You're like, okay, what do you mean? It's in your name. You pay for it with your money from your pay, your after-tax income. Generally, asterisks, for income protection contracts, anything that you pay from your after-tax income is tax deductible. Most people's eyes light up when they hear that. You can, however, structure it through superannuation. You just need to know that superannuation income protection contracts, the ones where you go through that hoop jumping that I talked about in the last episode, they will still have superannuation law to contend with. So superannuation law says a lot of the bells and whistles that might exist in other income protection policies, like the one I have, which I pay for myself, can't sit inside superannuation because they actually don't meet the definitions of super law to get it out. So normally if you hold a retail insurance policy for income protection through super, you're not going to have all the bells and whistles, which might be perfectly fine for you. You're paying for it from super money, and therefore you're not claiming it as a deduction because it's already coming from money that has a different tax environment. But it's not as superior, I guess might be the right word. It's going to be watered down. There is a third option where you can do a bit of a hybrid, where you can have the bits that are going to meet super law get stuck into superannuation style contracts and are paid for through your super account, but the bells and whistles and the extra sexy stuff that you might want access to can't sit inside super and needs to be paid for outside of super, and you can do that. Again, I would get a financial advisor or an insurance specialist to help me tinker with that. But income protection is often quite expensive, especially if you're young, especially if you work in an occupation that is considered additional risk. But if it means that it is covering a percentage of your income until retirement age, think about what cost they are potentially shouldering if you're not able to work anymore. So personally, I have premiums that are a couple of $100 a month, and I'm like so delighted to pay them. They come out on the 16th of every month. I see them and I'm like, hello, goodbye. I claim that as a tax deduction for my income protection. But because I'm uninsurable, and I'm currently going through the claims process, still going through the claims process, if you've been following me here, that is still ongoing. I'm delighted to pay it because I know that I'm covered and I am in my 30s and do still have a big working, hopefully, career ahead of me, and I want to make sure that I am covered. And I presume you do too. And if you don't have income protection, it's probably more just that you didn't get it inside superannuation, or you've just never really thought about it. Because, of course, as a society, we are really great at ensuring things that go down in value. But most of the time, if you think about it, our income opportunity goes up in value. We need to be covering ourselves. So let me give you some detail. Actually, let me step back because I should have said this when we were talking about super and non-super ownership. And potentially I should have even said it in the last episode. If you are uninsurable, something's happened, but you've already got cover in place and you're like, oh, I need to keep that alive and well. A la me. It is really important that you understand that there are laws in place now that say if your balance is under a certain limit or threshold, or if you haven't made contributions for a certain period of time, they will cancel your cover. Why does that matter? Well, you may have had insurance that came with your last super fund. So let's say you used to work for Company A. Hello, Company A. They set up a super account for you when you started working for them. Automatically, you were given some insurances, all fine, all good. Something then happened in your medical world, which means you're no longer able to get either any cover or cover similar to what you've been given already. But for reasons that we will not cover today, you've decided that actually you don't want your super any longer sitting inside that original super fund that Company A gave you. So you've decided to move your super to a new fund. Fine, but many people have left Company A's super fund in place, alive, with a little bit of money in there to protect that insurance, which was working really well until the government several years ago was like, yeah, we don't want insurances to erode people's super balances. So if it's under this amount of money or they haven't made any contributions in this amount of time, we'll cancel it automatically so that they're not being eroded, which is a pain in the ass if you've strategically left it there for very specific purposes, like I have. I have 3 super funds for exactly this reason. So most super funds will have a minimum threshold of like $6,000, but every super fund appears to have a slightly different take. So like have a look and see what the minimum is, or you haven't made a contribution for 16 months. It might just be with your regular super fund. You might have just taken parental leave and extended your parental leave, and God forbid no one has made any super contributions. You will find that unless you ring them and tell them and or complete paperwork, that automatically cancels. So if you've kept an old fund alive and well, call your fund, to tell them why you've left it if you're trying to keep that insurance alive, and ask them what you need to do to make sure that that policy doesn't cancel. Fill out whatever paperwork they tell you to do. Or you need to diarize to make sure you do a contribution into that account that you've left open for your insurances at least every 16 months. I would say once every 12 months to be safe, but like you do you, which, there's a human intervention manual error risk there. So I would always just suggest you fill out whatever paperwork you need to. But of course, if your premiums are high, at some point that money's going to run out. So you also just want to make sure that you are looking at the balance in case you need to top it up. So there's that. I can see why people check out, because it does get confusing and there's lots of details and fine print. But we are just going to accept that these are the conditions we play in, and we can whinge about them all day, and they are fair whinges. So fair. But it is what it is. And I'd rather you whinge and mumble and grumble and get it done than the opposite, which is live your bestest life until shit hits the fan and then you fall far and fast. No one wants that. I feel like I'm doing a lot of scaremongering in this series. You are so welcome. Let's talk about definitions that are important for income protection. The detail is really important. So generally speaking, income protection is offered as a percentage of your income. They are not going to pay you, generally speaking, 100% of your pre-disability income, so the income that you had before you became unwell due to illness or injury, because frankly, where is the incentive for you to return to work? You're getting 100% of your income, you don't have to work, you're at a risk of staying on claim. They don't really want that. And so I would argue that the percentage that they give you is kind of a quote unquote incentive to return to work. No one really wants a, 20, 30, 40% pay cut. It's going to cause pain. Could you live with a 20, 30 or 40% pay cut without serious pain, without serious changes to your life situation, be it where you live or what you do with your money? Most people couldn't, especially in these times, my friends. So you need to remember that the amount that they have covered you for is not going to be your full income. And actually, if you do have income protection, be it in super or elsewhere, you will notice that they have a monthly benefit amount. That is a pre-tax amount. So if you look at that and you're like, oh, yeah, obviously, I wouldn't be able to do many fun things, but I could make it work. I could live off that amount. It would then be shite to realize, oh, Jesus, I have to pay income tax on that. Now I'm left with way less than I thought. No, I absolutely could not live off that. So you need to remember that when you get a pay increase, you can apply to increase your cover. And again, depending on how it's structured and all the things will determine what that process actually looks like. For example, I have an old retail insurance policy, income protection policy. And one of the bells and whistles that I have is that I can increase my income protection monthly benefit, so the amount that I'm covered for, within 30 days of my renewal. So it renews every year. In June, I can increase it up to 25% without medical underwriting. So I don't need to go through all those hoops that I talked about in the last episode up to a certain threshold. Now that is absolutely friggin' banging and smoking for someone like me. I don't know if you can use those words to talk about income protection, but you are welcome. Because I know that if they looked at my updated medical events, they'll be like, yeah, no, we are so not covering you for any more than you're already insured for, you are a massive risk. Which I kind of am because I've got claim forms in my house. But again, this is where we want to know the detail. So if I know that I can increase it to a certain threshold when I'm not on claim, I haven't been able to do it this year because I'm on claim or going through the claims process, up to a certain threshold, that is amazing for someone like me. And again, it future-proofs my situation so that at the very least, I'm keeping up with my income or close as I can get as I push to that N25% max. You may not get that if you've got, not as many bells or whistles. It really is you get what you pay for with insurance. And I'm really frustrated to tell you that women tend to pay quite a lot more for income protection because seemingly we claim more for income protection than men. And young men in particular pay more for total and permanent disability and life insurance, which we'll talk about we'll talk about TPD in an upcoming episode. So you've got to be prepared to pay a little bit of money. And when I say a little bit, it could be a lot bit. So you've also got to figure out, okay, what is the right balance between protecting myself and having a level of monthly benefit that is actually going to work for me versus not having all my money go to insurance premiums at the expense of actually being able to do my financial goals, pay off that debt, buy the property, put money into the share market. There's always this dance. And again, this is where an expert can help you. But the irony is the people who have the least amount of money, the least amount of financial wiggle room, the people who are likely to say, I have no capacity to pay for these premiums, they are often the people who need it the most because they are the ones who are going to be in the most strife if something happens and they can't work. I am aware. It is really, really unfortunate that that is the situation, which again is why some people choose superannuation style policies because albeit that it's being paid from their super, which is reducing their retirement balance, they are covered and they are comfortable with that trade-off. Something for you to think about. So we need to consider what percentage of our income is going to be paid at claim stage. Some companies pay more than others. Some companies will pay a certain percentage for a couple of years, and then after that we'll reduce it down. Get into the weeds on that stuff because you might look at a company and be like, whoa, that premium's heaps higher. Nah, don't want them. But then if you're looking at why they're higher, you might find, they actually don't reduce down the percentage. So I could maintain this percent the whole time. Whereas the other one, which I was 10 seconds ago thinking was awesome, they are going to halve the percentage that they're paying or at least drastically reduce it after 2 years. No wonder it's cheaper. You don't want to find that out once you've been on claim for 2 years and then suddenly the insurer is going, hey, we see you're still on claim. Now your new monthly benefit is 20% less of what you've been getting. And you're like, why? And they're like, as per page 471, this is what the contract says. Yeah, not when you want to find that out. People often say to me, is this cover available if I become redundant? Now, it depends on your contract, but if it's anything that's I've seen in the last 15 years or so, the answer is probably no. We did see when I was first in insurance land, pre-GFC years, some contracts would cover you if you got made redundant. But as you can probably, possibly, definitely imagine, during the global financial crisis, a lot of people got made redundant and therefore insurers, most, maybe even all, actually pulled that out as a clause. We are seeing some contracts come to market which are actually designed specifically for that, but the vast majority, overwhelming majority that I've ever seen cover you if you are sick or injured and crucially unable to work. That is how income protection is defined. You're unable to work, which brings me to the next point that you need to understand is what is your waiting period? The waiting period is how long you need to wait before you can actually become eligible to make a claim. And so there are lots of different options. The longer that you wait, the cheaper your premium gets because you have less chance. I mean, statistically speaking, the longer you're waiting, the more chance you have of recovering and getting back to work. So it makes sense because your claim risk is lower to the insurer. The shorter your waiting period, the more chance they have of being on the hook to pay you, which is why your premiums will generally be more. So I have seen waiting periods of 14 days all the way up to 2 years or 5-year waits and somewhere in the middle. A 14-day wait is normally extraordinarily expensive and would signal to me that you don't have any emergency savings. Like you couldn't even handle your bills for 2 weeks. Ideally, you would have emergency savings so you didn't have to handle that bigger premium and be able to push out your waiting period. Normal waiting periods on average are like 30 to 60 days. Then you might be thinking, who on earth is doing a 5-year wait? Like, are they the most patient people in the whole world? How could they make this work? It could be a couple of things. They might have another insurance policy that has a 5-year benefit period, which we'll talk about in a moment. And so their idea is, okay, well, I'll claim on the one that's only going to last for 5 years. And then if that one expires because I've been on claim for 5 years, then the other one that has been patiently waiting for 5 years will continue on. So like you can be a bit strategic, but you can't have more than one income protection policy paying you at the same time where you go over and above a certain period. Otherwise, everyone would just have like 5 income protection policies and be paid much more than their income. Yeah, no, that doesn't work. The insurers have like clocked onto that. Basically, they've tried to figure out in what ways could you try to scam this and how do we protect us from that happening. We are not paying you 300% of your total income because you've insured yourself with several people. The maximum you will get is a percentage of your pre-disability income. In most instances, it is your pre-disability income, which I'll talk about in a moment. So, waiting period, think about how much emergency savings have you got? How much long service leave, annual leave? Sure, but like Murphy's Law will tell you, you're going to get sick potentially when you've used it all. So I always like to use emergency savings as my yardstick, but you might have circumstances where you're like, absolutely not. I spoke to someone, because I am such a loser, on Friday night when I was at a barbecue because like what a delight and joy it is to be my friend. And he was like, I have over 100 days of long service. And I said to him, okay, but like, aren't you going to use that to like, I don't know, kumbaya, eat, pray, love? He's like, no, that is my get out of jail free card. I said, you have no interest in using your long savings ever, long service leave ever. He's like, no. I was like, okay, cool. For most people, though, that's not their plan. Their plan is to use it to go, I don't know, and do whatever they want to do with it. And so then you can't really think of that as emergency savings if there is a risk that you will have used it. So what waiting period is appropriate for you? It is perfectly fair and reasonable to put a waiting period that's shorter in force or put that into position straight away. And then over time, as your assets build, as your emergency savings builds, you might want to push out your waiting period because you can withstand more financial shocks over a period of time. And of course, as you're able to push that waiting period out, normally that will reduce your premium. Something to think about. Waiting periods are normally paid in arrears. So this is important. So if you've got a 30-day wait and you're like, okay, I can handle 30 days, you will be pissed probably when you get sick and you're like, dear insurer, I've been off for 30 days. Here's all my paperwork. Here's the doctor saying I can't work. And the insurer goes, yes, we've accepted your claim. We pay 30 days in arrears. So you'll get your first claim at day 60. And you're like, sorry, what? Yeah, they pay it in arrears, normally by 30 days. So you need to factor that in as well. If you've got a 30-day wait, you won't get your first payment until 60 days. Devil in the detail. How many times do you reckon I can say that over this mini-series? Too many. Now, we used to have different styles of contracts, and I have an older one which doesn't exist anymore, frankly, I think because it was too unprofitable for them. But what I do want you to know is that there are contracts, again, you know, this is why you want to make sure that you've got the right bells and whistles for you. And like, genuinely, I don't even know if these are still on offer, but I'll tell you my situation because I have been going through this process. I have a 30-day wait and I actually have a plus or premium or some pretty name option on my contract, which like you might go, oh, income protection or income protection plus or income protection platinum or whatever they call it. Sounds the same. However, there are some contracts where you need to be totally disabled for a certain amount of days in the waiting period before you can be eligible to claim. Sometimes it's only 5 consecutive days in that 30-day period or 60-day period or whatever it is. Sometimes it's more than that. My contract, as an example, has what's called a partial claim payment. So you don't need to necessarily be totally totally incapacitated to not be able to work at all. You might just have found yourself, for example, needing an organ removed and working part-time once you get out of hospital. Just as an example, if you don't have a partial payment option, then you probably don't meet the definition to be totally disabled and paid out. My Plus or Premier or whatever the hell the option is says that I can go on partial payment from the very beginning of my claim. I don't need to be totally disabled first. There are many contracts where you actually need to be totally disabled, whatever their definition is, before you can even think about going on a partial payment. And look, for some people that might be right. They might be fully out of the workforce for a period of time while they're sick and then slowly but surely recover and start going back to work in a partial capacity. But I am here to tell you that there are other people, a la me, who once I got out of hospital, again, I went in several times, I was so desperate to go back to my life as normal. I just wanted to go back to part-time work. I wanted to work a couple of days a week, and my definition didn't preclude me from doing so. And so again, this is the sort of stuff that you want to check, because if you want the option to return part-time or for a couple of days a week and be supplemented for the difference, maybe it's because you work for yourself, maybe it's because you just know you would want to get back to work, or you just want to have the option to be able to claim on that should that happen, then you need to make sure that that is something that you're covered for. And you need to understand what the definition for total disability is, because someone's definition of you need to be totally disabled for, I don't know, let's call it 5 consecutive days in the 30 days. That is a whole heap better than a definition that says you need to be totally incapacitated and unable to work for the entire waiting period. Which one's going to cost you more? Probably the one that says you only need to be disabled for 5 days or unable to work for 5 days, because the chance of you getting a claim paid out is a lot higher. See how this devil is in this detail? See the devils? They're everywhere. So cost is important, but you need to understand what you are paying for. And I really recognize that you are going to need to make trade-offs, because you are going to. There's no point having the bestest insurance policy in the whole wide world, covered for absolutely everything you could ever want to be covered for, and not save any money. So you're going to have to figure out what are the priorities for you. But it is something hugely important to be aware of, because you need a doctor to say you can't work, and how long they have to say you can't work for is hugely important to be able to get a claim paid. You know what I mean? Okay, the other definition that I want you to understand, or term, is what's called a benefit period. Now, we could argue that the idea of a benefit is possibly not the right language, because you're ill or you've had an accident and you don't feel like this is a particularly beneficial time in your life, but alas, this is what they call it. So the waiting period is how long we're waiting. Remember, how long we're off work, how long we're waiting until we can start getting paid in arrears. The benefit period is how long will you pay me for? Now, some contracts will say we'll pay you for 2 years. Many inside super will say they'll pay you for 2 years. But you can get contracts that cover you all the way up to age 65 or age 67. And if you know, frankly, that if you were off for 2 years, when that 2 years is up, you've still got bills to pay, and life won't suddenly be financially significantly easier, then I ask you, is a benefit period of 2 years really the right one for you? And it might be. But if you're hoping and praying and wishing that A, it never happens, join the club, B, that suddenly your financial situation will be totally different and thus you won't need it for longer than that, let's just do some reality check there. Because for most people, high income earners, low income earners, the overwhelming majority of people that I've worked with could not withstand their bills indefinitely, even if they were looked after for 2 years. Are many people back up and working within 2 years of an event? Yeah, a lot of people are. But there are also a lot of people who have events that they never saw coming that pop up and stay for a long period of time, or they come and go. I've seen people with things like Crohn's disease where, they are sick for an awful period, and then they might have a recovery and get back to work, and then a few years later, they might have another flare up. You might be diagnosed with something like someone I know who was diagnosed with MS, who it just literally came out of the blue. And over time, sadly, their ability or capacity to be able to work was further and further and further reduced to the point where they could no longer work anymore. Insurance is one of those ridiculous things where we buy the ticket to the lottery that we hope we never win. We put our money in the pot and think, shit, I hope my name is not drawn out of the hat this month, this year, this decade. But a better, option than praying and hoping and wishing like hell that it never happens is to just do something about it, especially if you know that you are single, if you know that your partner wouldn't be able to cover your income, if you know that your bills wouldn't be able to be met, if you know that your children wouldn't be able to be looked after sufficiently from a financial standpoint, and that you would be very stressed and potentially trying to return to work when you shouldn't be, then these are all the signals to me that your probs need income protection. But again, once you have built up enough assets, you may look at that and go, yeah, nah, don't need that anymore. Okay, after the break, I am going to come back and do a couple of wrap-up pieces that I think you need to know about income protection, do's and don'ts and trips and traps to help you get yourself sorted.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to moneypodcast.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia so they can connect with you wherever you are. That's moneypodcast.com.au and click Get Help.
Okay, welcome back to what can only be described as the most motivational and exciting mini-series y'all have ever had the pleasure of listening to. Remember, we choose our hard. We choose our hard. I say this a lot. I say it to my greenhouse members, to my evergreen members. I'm like, look, in life we are often just choosing hard. Are we choosing hard now or are we choosing hard later? And let me tell you, when it comes to insurances, if you are not choosing hard now, you are absolutely choosing hard later. And that is a time where you think life is hard now, you think life is busy now. Throw in a health event, a serious illness, a serious injury, and the calamity of that, your hard has become way harder than it needed to be. So I respect the fact that right now you might not enjoy some of the things that I'm telling you. And I hope that I'm explaining them in a way that makes some vagrants of sense. But if one of you, beautiful people, gets your shit sorted because of listening to this and it saves your ass in the future, I feel like I have done my job. And if you do go and do your insurances, or at least even just review them or try to sort your stuff out, I want to know, obviously I want to know, DM me, Jess Brady _financial advice on Instagram. I will celebrate the bejesus out of you because I am full of the stories where people say to me, actually a lot of it's in my LinkedIn DMs. I think it's because I do a lot of corporate speaking where they're like, hey, I saw you speak at my workplace like last year or a couple of years ago, and I just wish I'd taken your advice, and I feel like an idiot. Like there's just so much shame, and I'm like, oh, I'm so sorry, something bad's happened. And in my head, I'm like, oh, I really wish you did take my advice. I really wish this bad thing didn't happen to you, but I also am like grateful that you've told me because now you get it. And people are like, oh my God, now I'm like harassing everyone I know. I'm like, welcome to the club. We share our insights. So if you're uninsurable, please don't think that you don't have something to help and support. Please spread the message because you never know who you might be able to impact, who needs to hear it. Okay. So we've already talked about the fact that if you have an income and you don't have enough assets yet to protect you or cover your income, your probs need to think about whether income protection is a priority for you. Do you have it inside super? Is it any good? What's your waiting period? What's your benefit period? What is your monthly insured amount? Do they line up? And are the definitions good? Most people who want bells and whistles will need to go and get that retail contract where they apply, be asked all those questions so that they can get the cover that fits them, get an insurance person to do that for you. Things that I want you to remember, or not even remember because you may never have learned about income protection before, but there are occupations that will not be covered. If you are too quote unquote high risk, either from a medical sense, which we've already spoken about in the last episode, but also from an occupational standpoint, they may not cover you. You might find to be covered for your occupation, you are charged a hell of a lot more than someone who is the same age, sex, weight, family history situation. You might have two twins with exactly the same information on paper. One of them chooses one particular job and is charged one amount of money, and the other chooses what is considered a more dangerous or high risk to claim job, and their premiums can be wildly different. Thus, if you get income protection and you're in a job that is considered higher risk and you move to a job that is less risky, tell the insurers, because they can change your occupation category or rating to reduce your premiums down. Now, inside superannuation, the ones that come with, I actually think that they rate you almost all the same, which is weird because if you think about that, and if that is still how they do it, white collar people who typically were seen as less risky, although back issues have kind of caused a bit of a cat amongst the pigeons there, they were paying more because they were sort of melded in the same pot, if you like, as heavy blue collar workers who were paying less. They were kind of cross-subsidizing each other, which works well if you're in a heavy blue occupation, but not great if you're in a white collar, seemingly quote unquote low risk occupation. So just check that out. And if you've got a retail contract, and as I said, you have changed to be in a quote unquote less risky occupation, get that reviewed. In saying that, if you joined in a white collar low risk occupation as deemed by the insurer, and then you go and join the circus, you might need to tell them, but in a lot of instances, you don't need to tell them. As long as you had no intention of joining the circus, if they even still exist, before you got the cover out. Again, this is why they're so thorough at the beginning, because anything that changes in your world, they may have to just cope with. Check the details. This is also important because I absolutely recognize the frustration with this. And I've had so many people give me, let's call it feedback over the years. Income protection is designed to give you a monthly drip-fed amount of money to cover your income. Not the full amount, which we've already talked about. But there is nothing more frustrating and even perhaps demoralizing or just exhausting than having to constantly tell the insurance company, yes, I'm still sick. Yes, I'm still sick. Month 3, yes, I'm still sick. But that is more than likely what you're up for. Now, with some injuries, they will potentially do what they call a pay and close. Like, hey, you broke your leg. You're in a white collar job. We think on average, someone with a broken leg in your job takes 6 weeks off. We potentially are prepared to give you 6 weeks, close the claim. If for some unforsaken reason you are still off work and you need to come back, we can reopen the claim. Do you want to do that? Most people will say yes, please. Then it's less administrative burden from their end, less administrative burden from your end. Hopefully everything's hunky-dory. You're back at work in 6 weeks. Everything's fine. But with stuff that's not as clear-cut, it doesn't always work like that. In fact, it very rarely works like that. So if you've got cancer, as an example, having to every month deal with a claims consultant or fill in more paperwork to say, yes, I still am off work because I have this cancer, is infuriating, actually, is the feedback that I've received. But that is the process. You might find that you've got an insurance contract with a company that will do teleclaims. So they will just call you and be like, hey, where are you up to? Hey, we'll just get a doctor to confirm that. You might get one with old school providers who are like, we need you to go back to the doctor every month to sign off that you're still not well enough to work. Like, these are the conditions that you need to know you've signed up for. And again, you don't want to find out at claim stage that this is the process, or at least you just want to be informed that that's what's going to happen. Because if that is what's going to happen, which in most instances is what's going to happen, then you can at least be as prepared as possible, and your advisor or insurance expert can help you with that claim paperwork. And trust me, having done it myself, it is long and so boring. That's what you want to use them for. There are a lot of lawyers on Google who say that they will do all of this for you and fight the insurance company to get a claim paid. I would always recommend general asterisks going back to your advisor or insurance consultant first. They normally, and it depends, they normally don't charge to manage your claim for you, whereas lawyers will typically take a percentage, potentially a large percentage, of any successful claim to manage that for you. Now, you may want to get them involved if it's a bigger thing and it's more convoluted and complex and your advisor can't help you. But the starting point would always be to get support to do that claims process. And if you can, I would do it through your advisor or your insurance expert before you call in the legal cavalry, because it will erode the amount that you have. Obviously, if you're applying for this insurance, all of the things that I was talking about before in terms of the underwriting process from the last episode is very relevant here. And remember, they are looking at not necessarily just you, but if 100 people had the same illness, injury, situation as you, would one of them claim? And that's probably how they're going to assess you. For that one person percentage risk, they're going to assume that's you. And so they're going to be quite tough in my experience. And you want to look at whether getting that reviewed in time or not is an option and is relevant depending on what your circumstances are. Okay, so we want to make sure that we are covered for the right monthly benefit, for the right waiting period, for the right benefit period. We want to make sure that we have reviewed our exclusions or loadings if our situation has changed. If our occupation has changed, we want to potentially get that reviewed if it means it's going to be a better premium. We need to understand what we're up for if we go to make a claim, and who is going to help manage that. If you've got a person that's helping you put it in place, check with them if they can help you on the other side if this happens. Normally, this doesn't interact with any of the other policies that we're going to talk about in the upcoming episodes. So that's important to note as well, because what we're trying to do here is keep the lights on. We're trying to keep some level of income coming in so that you can keep maintaining your bills. And let's just call it out, because I talked about private health insurance earlier in this episode. This is not extra money to cover whatever crisis is unfolding. This is not at all looking at how much you have financially been out of pocket for particular health events. This is literally just trying to reimburse you for a percentage of your income. So as your income changes or as your life changes, you need to make sure that the monthly benefit amount is appropriate. You might find that you were quite happy to have a lower monthly benefit up until a little while ago because you could totally have survived on a lesser amount, but now you've got a massive mortgage. You're like, oh no, this would not be ideal. Or now you've got a child. You might be like, oh shit, we couldn't handle that if my income went down by that amount. Check and see if you're going through a period of hardship rather than cancelling the contract. Firstly, if you're going to do that, think about why you're going to do that and if there's a way that you could tinker with the policy to potentially free up some money but still be covered for the worst case scenario. So maybe you extend out that waiting period, reduce the benefit period, whatever you might need to do. Just know that those options are generally available to you. Some policies have what's called a premium holiday, which sounds much more glamorous than it is. Basically, if you're going through a really difficult situation but you can't make a claim, so I don't know, you lose your job or something bad happens and you've got no money, call your insurance provider and ask them whether you can have a premium holiday. Sometimes they'll give it to you for a couple of months. It could get you out of a tight spot. But you need to know that your policy is on holidays, right? It's not going to cover you if something, God forbid, happens during that time. But it does mean that your policy is sitting on ice, if you will, so that when you are off that premium holiday or when you've got the money to be able to pay again, you're not going to have to go through that underwriting process again. Very, very important, especially if your medical situation changes. If you are off work for a prolonged period of time, you need to check your definitions. Because we have seen this in situations where people take parental leave. You want to know, how are they assessing a claim? Are they looking at just the last 12 months worth of your income and averaging that out? Because let me tell you, if you got sick 3 months after you've come back to work, let's say you had a baby, you had 12 months off and you've been back at work for 3 months and God forbid something happens. And let's say your definition says, we will pay you the average of your last 12 months' income. And some of them do say this. What you want to make sure of is that they are going to potentially exclude any periods of unpaid work. And not all of them do that. Because if they don't do that, what they're going to do is they're going to grab that 3 months of income that you've earned, because remember, you've only been back at work for 12 months, and they're going to stretch that out over 12 months and they're going to give you the average of that. That is not what many people would like in that situation. So again, detail is your friend here. I am going to do another episode once my whole claim process has been finalized. And I have been dragging my heels with this, to be perfectly honest, because my doctors need to be followed up, because I get it. They're busy helping people who, they're literally saving lives. And I'm like, oh, hey, here's 20 pages that the insurance company wants to have you complete. It just goes to the bottom of the barrel, which I totally respect and understand. But it is also a pain in the ass, to the point where I'm like, do I just book in an appointment and pay for it so that I can get this paperwork done? But once my income protection claim hopefully and most successfully, is paid. I will do a deep dive on how I found that process because it has been an interesting one already. I think most people need income protection. I think it's insane that we insure our cars that go down in value and not ourselves. You would not have the car if you didn't have an income for a giant period of time. Let's be honest. I think you want to have this conversation with your partner and have really good alignment about what you're covering at what levels, because remember, if they don't have insurance and you are a team who as a team are collectively responsible for bills and would be screwed if they couldn't cover their income for a period, then your probs want them to get income protection or at least investigate income protection options as well. Go and talk to your friend who just got the promotion. Go and talk to your friend who's just started in their grad role. Go and talk to basically everyone that you know that has an income and ask them, do you have it protected? And you'll probably be quite horrified to see that the overwhelming majority of people do not. And yet everyone we know, not everyone we know everyone knows someone who has had something that has tripped them up from an income perspective. And if you're like, no, actually I don't, then I would like to offer myself as a sacrifice. You are so welcome. My brother is on week 2 of time off for having his appendix out. Hope he doesn't mind me telling you. He went to take his daughters to swimming lessons last Saturday and was in so much pain he couldn't actually get there. So he dropped them off at their grandparents' house and then, for reasons that I cannot explain, decided to drive to the hospital instead and was found to have whatever it needs to be called, appendectomy, whatever it's called when you get your appendix taken out. And I did say to him, after years of berating him for his insurance, my friend, did you get that income protection sorted? I haven't received an answer on that one, so I hope that he is busily working with his financial advisor to potentially get him claimed. Hopefully he'll be back up at work and back to normal sooner rather than later. You just don't know what's in front of you. We just don't want you to not protect yourself adequately. And we just want you to be covered for the right amount at the right time for the right thing. In the next episode, I'm going to go through the next 2 episodes. I'm going to go through the other 2 types of insurances and how they all lock in together and what you need to consider. I know today we got a little bit into the weeds because I'm me. If you've got questions that I didn't answer, please send them through to me, Jess Brady _financial advice on Instagram, or you can email me hello@jessicabrady.com.au. I do weekly money dilemmas for my newsletter community. If you've got a particular issue that you want me to cover, let me know. Otherwise, homework for today is to go and see what you got, what you need, and where the gaps are for your income. That is all from me. Go now. Go and be financially fierce. Good luck. Goodbye.
We acknowledge the traditional owners of country throughout Australia. We pay our respects to elders past and present. Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the product disclosure statement, PDS, and target market determination, TMD, and obtain appropriate financial advice tailored to your needs. Jessica Brady is an authorised representative of Paragem Pty Ltd, authorised representative number 1259972, AFSL 297276, ABN 16108571875, corporate authorised representative number 1305567.